Hi, my name is Jin Choi and I'm the founder of Money Geek, and welcome to the 8th episode of the short course on investments. And today we're going to talk about commodities as investments. Simply put, commodities are physical things. So for example, there's things such as oil, copper, wheat, and even livestock are all examples of commodities. But not everything is a commodity. For it to be a commodity, there has to be a lot of those things. For example, copper is a commodity because there's a lot of pounds of copper in this world. And 1 pound of copper is very similar to that of the next pound of copper. But conversely, the sweater that your grandma knit you is not a commodity because there's only one such sweater in this world. Most commodities trade on commodity exchanges, and these exchanges are separate from that of stock exchanges. And that means that you can't use your brokerage account to buy a herd of livestock, for example. However, you can buy ETFs that hold commodities through your brokerage account. And for some commodities, you can even buy the physical thing. For example, you can buy gold and silver coins through some merchants. Now, among all the different commodities that people can buy, one commodity in particular grabs people's attention more than any other commodity, and that commodity is gold. So for the rest of this video, let me just focus on gold as an investment. Until 1971, the US operated on something called the gold standard. And that means essentially that the US pegged the price of gold at a certain number of US dollars, which means that the price of gold didn't really fluctuate a lot until 1971. In 1972, the US abandoned the gold standard, and since they've done that, gold prices went from $19 an ounce to around $1,300 an ounce today in 2014. And that represents about a 6% per year gain year over year for the past 40 years. In other words, if you had held gold since 1972, you would have realized an investment gain of 6% per year for 40 years. However, gold wouldn't have been an easy investment to hold. Historically, gold has a standard deviation of 25% annualized, which means that gold was a much riskier investment even than stocks. If you recall back to episode 3, I mentioned that stocks have returned around 9% per year for the past 100 years, and it came with a standard deviation of 15% annualized. So in other words, gold has returned less than stocks. At the same time, it's been riskier than stocks. And for those reasons, gold has not been a good investment. But that's how gold has done in the past. But that doesn't guarantee that it will look like that in the future. So isn't there a chance that gold will perform well in the future? Well, although many people debate on this subject, it really all boils down to one thing, and that's inflation. So those people who think that gold prices will do well in the future, think that inflation will go up in the future. And those who think gold won't do as well in the future, thinks that inflation will remain subdued. In other words, everyone agrees that inflation drives gold prices. It's just that they have different views on inflation. And if you think about it, this makes sense. That's because owning gold is not like owning stocks. When you own a stock, you own a piece of a company, and a company either shrinks or grows over time. But gold doesn't do that. Whereas gold doesn't lose its shine over time, it doesn't grow or shrink either. And that means that a piece of gold will look exactly the same 100 years from now as it does today. That means that we can roughly expect it to be worth the same amount adjusted for inflation as it does today. So the question becomes, what will happen to inflation in the future? Well, historically over the past 100 years, we average around 3% per year inflation in North America. And that means, and during this time, we went through world wars, We had oil shocks, we had depressions, we had financial crises, you name it, we had it. But through all of that, we had 3% per year inflation. And if we assume that the next 100 years will look like the past 100 years, with all the mess that came with it, we might still end up saying that we expect around 3% per year inflation. And that means that we may get only 3% per year rate of return on gold. And in my opinion, this is not nearly enough return for a highly risky investment like gold. And for this reason, I'm not a fan of gold as an investment. And not to mention that if you really are afraid of inflation, then there are better products out there to protect you from that, in my opinion. And that's what I had to say about gold and commodities. So let me quickly go over what we've learned today. We learned that commodities are physical things like oil and wheat. And we learned that we can't directly trade commodities, but we can buy ETFs that hold commodities, so indirectly invest in them. Of all the commodities, gold attracts the most attention. And for the past 40 years, gold has returned about 6% per year annualized, and it also came with a standard deviation of 25% annualized. That makes gold a highly risky investment. The future of gold is uncertain, but experts agree that it will probably track inflation. And if the rate of inflation in the next 100 years is similar to that of the past 100 years, and if gold does indeed track inflation, then gold will probably not give a high rate of return. And for this reason, I don't think gold is a good investment. So that's what I had to say about gold and commodities. And again, if you liked what you saw in this video, please consider sharing this video with someone you know. In the next episode, I'll talk a little bit about life insurance. So thank you very much for watching, and I hope you have a great day.